When I started out on my financial journey over 10 years ago, I stumbled upon a story that changed my life forever. And I think up until that point, I didn't really understand why investing is so important. But after I heard that story, I did. I read it in a German book, and here's the story. If Joseph would have put 1 cent into a bank in year 0 at an interest rate of 5%, then after 2,000 years, he would have accumulated 23.9 duodecillion euros. That is a number with 39 zeros, and it is equivalent to 118 billion Earth globes out of pure gold. Man, my mind was blown. And here comes the really interesting part. What would have happened if Joseph would have taken out the interest every year? So he puts in 1 cent, he earns 5% on that 1 cent, and every year he takes out what he earned on this 1 cent and then puts it under his pillow. After 2,000 years, he would have $1. And that is the difference between simple interest and compound interest. Now, what does that have to do with the first $100,000? And obviously we don't have 2,000 years to let our money compound, but it does explain why the first $100,000 are so important for our wealth. So let's take a closer look at why. By the way, I'm Sophia, I'm a German doctor, and I love to talk about money and also how to build wealth without living frugal, which is also what we explore on this channel here. So the first 100,000 are so important for our wealth because of compound interest. Now there are 3 factors important for us in order to maximize compound interest. And the very first one is time. Now, even though we do not have 2,000 years to let our money compound, but time is still important. And let's look at an example. Let's say you find this video at the age of 25 and you invest $10,000 on the spot, nothing else after that. And you invested at an interest rate of 6% per year. Now that is a very conservative number. I calculate with 9.6% of an average return of the developed countries, minus 3% inflation, and then I round down. And then at the age of 45, so after 20 years of compounding, you would have $32,071. That means you will have tripled your money without any further investments. But let's say you discover this video 10 years later. So you start at 35, you invest the same amount, $10,000 once, and then nothing after that. Also the same interest rate of 6% per year, but you have 10 years less to let that money compound. And at the age of 45, you will have $17,908. So that is less than double just because of time. And even when you don't have much money yet, which usually is the case when we are younger, it was the same for me, but still time works in your favor, and that's why it's so important for us to start as early as possible. And also don't be discouraged, because in the beginning when you start, you will not see results immediately, and that is because of the second factor, and that is the principle. Now Joseph started out with 1 cent, but because we don't have that much time, we can leverage something else. And that is our principle. Ultimately, what we do is we use our money as leverage. But this only works when we put as much as possible towards our investments, because earning 6% on $100 is still only $6. Which is the equivalent of a coffee these days. I stopped drinking coffee, by the way, not because of the money, but because I couldn't sleep. Even from 1 decaf at like 5 p.m., I still noticed the impact that I couldn't fall asleep like as usual. But anyway, earning 6% on $10,000 already gives you $600. And that's already the equivalent of, let's say, 1 month of rent in a small apartment, or maybe an expensive pair of shoes. And earning 6% on $100,000 gives you $6,000 per year. Now that's already several months of living expenses. So in this example, the amount of interest is always the same, the 6%. The amount of time is also the same, in our case 1 year. And just by how much we put in, so our principle gets us these different results. And that at the same time is the reason why it's so hard to reach the first 100,000, because the small amounts you put in the beginning also only earn you a small amount of interest. And at the same time, it's what lets our money explode after 100,000. Let me show you in a visual. I will use the compound interest calculator because That way you can also play around with the numbers after you've watched this video. I'll put a link down in the video description. So I like to use the compound interest calculator from investor.gov, and this is what it looks like. Now let's say you have 0 initial investment, but you are able to put $1,000 every month towards your investments. And I will put in here 40 years, because then we have a long curve that we can take a look at. And we'll use the estimated interest rate of 6% per year, no variance range, annually, and then calculate. So if we do this, after 40 years, we will have accumulated $1.8 million. That's not bad at all, is it? And now let's look at the curve down here. So you have the years. The blue curve shows you your total contributions, and the red curve shows you the future value, which means that the difference between those numbers, so the future value minus your total contributions, gives you how much interest you earn by letting your money compound. So in the beginning, you have to do the heavy lift. So here in year 2, for example, your total contributions are $24,000 and your future value is $24,720, which means in the second year you will earn interest of $720. And now I just slide along the curve and you see in year 7, you will cross $100,000 in net worth. So in the hypothetical example that you put $1,000 towards your investments every month, it will take you a bit less than 7 years to reach a $100,000 net worth. Now let's continue and see when you will cross the second 100,000, so the 200,000 net worth. In year 12, you will cross the second 100,000, so 200,000 in net worth, and from 7 years to 12 years, it's already only 5. So it's 2 years less than to get to the first 100,000. Now let's continue again. How much it takes you for the third 100,000. Voila! It's in year 16. So for the first 100,000, it took you 7 years. For the second, it took you 5 years. And now to cross the third 100,000, so to get to more than 300,000 in net worth, takes you another 4 years. And now when we keep sliding through this curve, the time you will need for the fourth 100,000 and the fifth 100,000, it will get shorter and shorter and shorter. And at some point, it will take your money only 1 year to get to the next 100,000. Because at some point, your principal got so big that you actually earn more just with the interest compared to how much you put in. So the first 100,000 is the hardest because it feels like work, it is work, and it takes the longest. And I feel like the hardest part in sticking with something is when you don't see results. But in this particular case, you just have to trust that it will get easier at some point. And I hope that also motivates you to start working towards this goal, your first 100,000. By the way, what I found the easiest for me to actually stick with this is by visualizing my progress. And the way I do that is by calculating my net worth. Now, I actually found out pretty late about the net worth and how it's actually calculated in my financial journey. Just real quick, a reminder, your net worth is everything that you own minus everything that you owe. I actually wish I would have had it sooner because it would have boosted my motivation even more. And for the past years, I have used an Excel sheet that I created myself where I just plug in all my numbers and then it automatically calculates my net worth. And I also have a graph at the end of it where I can see my net worth grow or not. If you want to use it as well, it's free. I'll link it down below in the video description. And now let's look at the third factor, and that is the interest rate. So unfortunately, we cannot magically get to a 50% return or a 70% return. That may be possible with one stock or one particular investment, but unfortunately, we never really know which one it's going to be. And by trying to go for returns like this, private investors like us actually lose the game. And by lose the game, I mean we end up with a return less than the actual market returns on an average. Because maybe we even end up having one good investment, but then we also have other investments that don't go as wished and they pull the whole average of our portfolio down. So what I personally chose for me is to not trying to beat the market, but instead just investing with the market, because I find that's the best way of getting a good return and at the same time minimizing the risk Because by investing in the whole market, you don't run the risk of losing everything because you put everything into like one stock or one particular asset. And by the way, we still leverage compound interest in the market. Because remember the example of Joseph's cent, when our money only grows with a simple interest, like for example in a high yield savings account, then this money only grows by how much you put in. So you only get the same amount of interest paid every year on the money you put in. So in investments like that, you don't earn interest on interest. So I don't want you to stress too much about the interest rate, but do invest your money. At least if at some point you want to see the returns we looked at in the compound interest curve. So ultimately, and also ideally, we need all three. So we need time. The longer our money can work for us, the better. We need to leverage money. So we need to put in as much as possible, especially in the beginning. And by beginning, I mean to reach that first threshold, 100,000. And even after that, the more you put in, the faster your money grows. And we need our investments to actually compound and not just grow with simple interest. And then we will be rich. If you haven't started investing yet, I'll link a beginner's guide to investing here. Thank you for watching, and I hope this helps.